The Federal Reserve has raised the federal funds rate by a quarter percentage point to a range between 1% and 1.25%. It is the third hike in a key interest rate in 6 months. It pushes the federal funds rate above 1% for the first time since the 2008 financial crisis. Earlier, Fed Chairwoman Janet Yellen explained her decision at her quarterly press conference.
Our decision to make another gradual reduction in the amount of policy accommodation reflects the progress the economy has made and is expected to make toward maximum employment and price stability objectives assigned to us by law. Overall, we continue to expect that the economy will expand at a moderate pace over the next few years. Looking ahead, we expect that the job market will strengthen somewhat further.
Miles Udland is a markets reporter for Yahoo Finance, and he joins us now on the phone to talk about what this all really means. So, Miles, Janet Yellen there speaking in very typical Fed speak, but break it down for us. What does the upping of this rate really mean?
Right. So I think the simplest way to think about it is that it is effectively the Fed endorsing where the U.S. economy is at. So they believe that the trajectory that we're seeing with economic growth, while perhaps disappointing to, let's say, the president, who is looking for 3% growth, they're pleased with where that's at. They believe that the labor market is in a good spot. We learned that in May. The unemployment rate fell to 4.3%. The Fed expects that it will stay about that point. So I think the overall takeaway is that things in the economy are proceeding as the Fed would expect and is pleased to see that happening.
And Yellen there saying she expects the economy, the U.S. economy, to continue to expand at a moderate pace. But why raise this key interest rate now at this stage?
Right. So I think what was interesting in the statement is the Fed really, so as Yellen referenced in that clip you played, they have a dual mandate, right? So they want full employment, but they also would like inflation to run at 2%. So currently they're missing their target on inflation. But given the strength that we've seen in the labor market, I think a lot of people expected that we'd see a slowdown in the number of jobs created each month, but we're still seeing in excess of 100,000 jobs added to the economy each month, still running north of 2 million jobs added per year. I think the Fed believes that that kind of strength warrants them raising the interest rate. And also, look, they were at a historic low. They had interest rates near 0% for almost 7-8 years. And I think they would like to get that rate higher so that in the next recession, they will have some, room to maneuver, as central bankers would call it.
And experts like you have long been predicting that because of those historically low interest rates, an increase was bound to happen at some point, and we've seen it happen steadily. But what does this mean for your average consumer carrying a credit card balance or hoping to purchase a home or a car? Is it just now slightly more expensive to borrow money?
Yeah, so the interesting thing about this is that we're talking about the shortest term interest rate. So if you went into a bank today and you were trying to get a CD, you would have access to a slightly higher rate because of that Fed funds rate. But if you look at the mortgage market, that is actually benchmarked to the 10-year Treasury, longer dated bonds. And those bonds have actually been falling in yield, so rising in price. And so I think for the average home buyer, things are where they were a year ago, which is to say quite strong. The 30-year mortgage has been basically where it was at. It rose a little bit after the election. And so on that basis, the Fed, seeing that kind of market reaction, is more comfortable raising its short-term rate because to the average American, to the average borrower, things have not changed that dramatically. So if you have a shorter term rate, maybe an auto loan, credit card loan, certainly, again, something like a CD, those rates might be going up. But the most important rate for U.S. consumers is the 30-year mortgage rate, and that rate has fallen and is stabilizing. So I think the Fed is quite pleased to see that.
And generally speaking, would you say this is a sign of a strong and growing economy? These are positive moves to take?
Yeah, I think overall, look, again, as I mentioned at the top line GDP growth is perhaps not where folks would like to see it. We're running somewhere around 2% per year. But all things considered, given the kind of washout we saw after the financial crisis, things are looking pretty good in the U.S. economy. There are a lot of jobs available. There are a lot of employers looking to hire employees. So I think the Fed and others would like to see wage growth increase somewhat. But overall, right now, I would say the U.S. economy is in a pretty good spot.
All right, Miles Udland, the markets reporter for Yahoo Finance, joining us on the phone from New York. Thanks, Miles.
Thanks so much.